Welcome to the Finance Essentials series, where we explain everything you need to know about financing your dream home. And today we are talking about construction mortgages, how they work, how they differ from regular home loans, and why they might be the right option for you. To guide us through this, I am joined by Mark Palakason, Managing Director from Mortgage Domain. Welcome, Mark.
Thank you very much for having me.
Thank you. So let's start with the basics. What exactly is a construction mortgage?
A construction mortgage or a construction loan is a loan that's designed specifically to fund a new construction property. Unlike a standard loan to buy an established property, you have what we call progress payments, which means the bank will lend you money in stages.
That sounds quite different from a regular home loan. Can you explain some of the key differences?
There are major differences when it comes to a construction loan versus an established property or a standard home loan. The way the loan is dispersed with a standard loan is you're only funding one payment from the very beginning. With a construction loan, it is done in stages. And the stages are normally base, being your slab, frame, lockup, fixing, and then completion. What that means is once the builder has completed each one of these stages, the money will get lent to you as a borrower, which means your loan repayments will increase every single month. Another difference is the interest calculation. So with a standard home loan, given that you've borrowed the full amount of money from day one, you'll have to pay principal and interest repayments on the full amount of mortgage. With a construction loan, what tends to happen is you'll start with a land component, which means you'll pay back interest-only repayments on that portion. And then you'll go through the 5 relevant stages of construction, which means once the slab's poured, the builder will send you an invoice, your loan will jump up by that payment amount. And that will continue for the remaining 4 stages of construction, being your frame, your lockup, fixing, and then completion stage.
It sounds like a construction mortgage offers more flexibility. Can you unpack some of the key advantages?
So some of the advantages would be lower repayments whilst you're under the construction process. So with construction loans, you're only paying interest-only repayments. With a standard loan, you're paying principal and interest from the very beginning. So that would then result in lower repayments whilst the house is under construction. Construction loans also give you greater security over your funds. So what that means is the builder's not getting the full amount of money from day one. They're only getting paid for the work they've actually completed. So once they've completed a relevant stage of construction, they'll then send you an invoice for that work, and then your loan will increase that month. The other benefit with a construction loan is the interest-only repayments. It's going to give you better cash flow whilst the house is under construction because you're only paying on what the balance is. It's always going to work out lower with the interest-only repayment compared to a principal and interest loan.
So if someone is ready to build their dream home, what's the process of getting a construction mortgage?
The process with a construction mortgage works very similar to a standard home loan, but it does require a few additional steps. So what you want to do is you want to start with the pre-approval, which means you're doing your necessary research in terms of making sure you're going to the right lender, but also submitting an application for them to approve the amount of credit that you're looking to take out. Next part of that would be to engage with a builder, and you want to get your fixed price building contract plans and also your specifications organized. Once the contract's issued, you'll then want to order a valuation. So the bank or the broker can order that on your behalf, and usually that process can take between 2 and 3 days. Once that valuation report comes back, we then send it over to the bank to then issue a formal approval, or we request for that. Once a formal approval has been issued, the bank will then issue a letter of offer or your loan documents, which means it's now up to you to accept the bank's terms and conditions. So once you've done that, it then goes back to the bank, and now they're in a position to start construction and fund your loan.
That was incredibly insightful. Thank you so much for breaking that all down, Mark.
That's my pleasure.
Thank you. So understanding how a construction mortgage works can help you make informed financial decisions if you're considering building a new home. Stay tuned for the next installment in the Finance Essentials series for more expert advice. See you next time.